Understanding business fundamentals is in many ways an investment in your own financial well-being. The more familiar you are with how businesses actually operate, the more likely you are to make decisions that support profitability, recognize early signs of decline, and respond appropriately. This knowledge becomes particularly useful when trying to make sense of the steady stream of information about startup culture, market disruptions, economic shifts, and the ever-changing landscape of consumer behavior. Eventually, of course, no business escapes entirely unscathed. At some point, something will go wrong, and when it does, having some insight into commercial mechanics can make you a more competent founder, partner, investor, manager, or advisor. Now, a business is not a simple machine. It's a complex structure composed of activities which group into functions which in turn form departments, which are organized into business systems. For the business to function properly, these components must not only operate effectively in their own right, but also coordinate with one another. Many functions wear more than one hat, contributing to multiple systems depending on their unique capabilities. Most people are more familiar with the customer-facing level of business organization, since this is where so many of our daily commercial experiences take place. You might encounter a slow checkout process, receive poor customer service, or hear about a company filing for bankruptcy. Each of these situations is associated with particular business functions, highlighting just how much our sense of commercial success and failure is tied to these operational structures. A function, fundamentally, is a set of related activities working together to accomplish a particular commercial objective. When several functions coordinate to perform broader tasks, they form a business system. These systems carry out essential organizational roles. For instance, there's the revenue system composed of marketing, sales, customer success, and pricing, all coordinating to generate income and maintain customer relationships. Though we won't trouble ourselves with organizational charts, you should know that each system includes specific functions tailored to its particular objectives. In this discussion, businesses are typically grouped into three overarching categories: those involved in revenue generation, those dedicated to cost management, and those providing operational support. These aren't rigid classifications, more like a helpful filing system for understanding commercial complexity. Take the human resources function, for example. It has been slotted under operational support because it facilitates the hiring and retention machinery, but it's also a cost management function, controlling labor expenses, and a revenue enabler, ensuring the right talent drives growth. The takeaway here is not to get too hung up on which box a function or department is placed in. In reality, just as functions collaborate within systems, systems interact constantly with one another. Every aspect of the business's design, from the smallest customer interaction to the largest strategic initiative, is interconnected. We often study these parts in isolation, examining profit margins separately from customer satisfaction or reviewing operations without considering strategy. But none of them operates in a vacuum. Consider the typical startup failure. This strategic misalignment affects cash flow, but the consequences ripple outward. Customer acquisition slows as marketing budgets shrink. Product development stalls as engineering resources are cut. Employee morale suffers, sometimes leading to talent loss due to deteriorating company culture. The business does not compartmentalize the way our business school cases might. Even the simple act of assigning a function to a specific system can feel slightly artificial. Most functions moonlight in more than one role. The sales team, for instance, doesn't confine itself to revenue generation alone. It has customer intelligence and market feedback duties as well. So while we use these systems and categories to navigate the landscape of business operations, it's wise to remember, in the end, everything is connected. Each business system carries out specific responsibilities and, for the sake of analysis, they're typically examined one at a time. But in practice, they do not operate in isolation. Rather, They form a sort of commercial alliance, coordinating their actions to help the business maintain viability, a stable operational state despite market fluctuations. Consider cash flow balance. The revenue, expense management, and working capital systems all lend a hand in this ongoing negotiation. The revenue and collection systems are responsible for bringing money in and are attuned to changes in payment timing and volume, adjusting pricing and terms accordingly. If your cash reserves climb too high, the investment system compensates by deploying excess capital into growth initiatives or returning it to shareholders. If reserves drop, it does the opposite. Expenses are cut, payment terms are extended, and collections become more aggressive, conserving what little liquidity remains. Pricing equilibrium is another example of collaborative regulation. The finance, marketing, sales, and operations systems all participate in keeping prices within an acceptable range that balances demand and profitability. When prices climb too high, demand contracts. The sales team reports longer cycles and more lost deals. Inventory builds in the warehouse. Marketing adjusts messaging to emphasize value rather than features. This explains why during competitive pressure, companies discount aggressively, adjust positioning, and develop distinctly defensive strategies. Though the discounting does double duty, also clearing excess inventory and generating cash flow to fund operations. If prices drop too far, the response shifts. Margins compress to unsustainable levels, threatening the business's ability to cover fixed costs. Finance raises alarms about profitability. Operations struggles to maintain quality with reduced budgets. The marketing team pivots to premium positioning, emphasizing differentiation. Sales refocuses on higher value customers willing to pay appropriate prices. These responses account for the price wars, margin pressure, and strategic repositioning that accompany market commoditization. Customer satisfaction is another tightly monitored function, with the operations system overseeing much of the execution. Satisfaction is required for an impressive list of outcomes: maintaining retention rates, enabling expansion revenue, generating referrals, and reducing support costs. Businesses gauge satisfaction through various channels, and the customer success team handles ongoing measurement. Here, the product and service delivery functions step into their primary roles. When satisfaction scores dip too low, the operations team investigates root causes. Support resources are increased, product issues are prioritized for fixes, and account managers reach out proactively. When satisfaction rises too high relative to price, the finance team responds with adjustments of its own, raising prices to capture more value or investing excess goodwill into expansion efforts. Meanwhile, sales teams take the positive sentiment and put it to use in acquiring similar customers. These responses, all orchestrated by cross-functional coordination, help maintain commercial equilibrium. The growth rate story continues this pattern. The strategy and operation systems work in tandem to maintain sustainable expansion. If growth slows below targets, leadership releases initiatives to accelerate it, which prompts the organization to increase marketing spend, expand sales capacity, or enter new markets, processes collectively termed growth investment. Revenue then accelerates, available for scaling operations. When growth rates are too high, the organization strains under operational pressure. Quality suffers, customer satisfaction drops, and employee burnout increases. Leadership applies the brakes, focusing on operational excellence rather than pure expansion, slowing hiring and constraining spending, which operations then absorbs as breathing room for improvement. Even market positioning plays a role. When competitive pressure intensifies, the strategy and marketing systems conspire to make the organization acutely aware of it. Competitors may gain share and differentiation may erode. These signals prompt adaptation, adjusting the strategic position. In all of these examples, cash flow management, pricing equilibrium, customer satisfaction balance, and growth rate control. Multiple systems cooperate to maintain commercial stability. The business is, if nothing else, a master of resource allocation under constraint. The strategic planning system, or simply strategy, is composed of vision, mission, and operational objectives, all of which are protected rather carefully by documentation, analysis, and regular review. The strategy, housed within leadership and management structures, includes three major components: long-term vision, medium-term goals, and short-term tactics. The business system also involves decision-making frameworks and resource allocation mechanisms that serve as its primary coordination channels. This system serves three main purposes. It gathers market intelligence, processes that information into decisions, and then issues directives to guide execution. Market intelligence is collected by various functions and supported by data systems and analytical frameworks. Leadership, the organizational workhorse of strategy, synthesizes inputs from customers, competitors, and market trends into the strategic plan. Once there, executive teams process the data, a function reserved largely for senior management. After integration, operational output occurs as leadership and management dispatch objectives to departments and teams, while strategy, composed of vision and plans, acts as the directional center. It works closely with the execution layer of the organization. The execution layer consists of a sprawling network of departments and teams that connect strategic intent to actual results. Within this layer, operational managers translate high-level objectives into specific actions and implement these through daily activities. The execution layer then carries out responses through coordinated work. The execution layer is further divided into the functional organization, which handles specialized work such as engineering, marketing, and finance, and the operational organization, which manages cross-functional workflows, projects, and customer delivery. These two aspects interact continuously, sharing resources and maintaining collaborative relationships. Strategy is not merely a planning document gathering dust on a shelf. It processes information and, according to numerous studies, may generate operational activity independently of formal planning cycles. In other words, it behaves rather like an adaptive system. Perhaps something to ponder the next time market conditions force a pivot before the quarterly planning meeting, misalignment between strategy and execution, or failure of strategic intent to reach operational teams can produce a wide range of dysfunctions. These range from minor inefficiencies, such as duplicated work, to more systemic issues, like entering the wrong markets, building unnecessary products, or misallocating capital across initiatives. Even when individual contributors work diligently, organizations can fail if the overall direction is flawed or poorly communicated. The structure of strategic frameworks reflects their function in setting direction and allocating resources. Frameworks vary widely in complexity, time horizon, and analytical rigor, but all share a few common features. The vision or mission statement contains the aspirational destination and establishes purpose. It ranges from a single sentence to several paragraphs outlining intended impact. Strategic objectives extend from the vision like branches from a tree, forming what's aptly called a strategy map. These are the primary checkpoints for measuring progress, though under certain conditions they can also shift in response to market feedback. The planning cycle is a recurring process that carries objectives from conception to execution. Some cycles extend over multiple years, particularly in capital-intensive industries, while others operate on quarterly or even monthly rhythms in fast-moving markets. At its origin, strategy emerges from leadership assessment at a phase called environmental scanning. This process examines external conditions, including market dynamics, competitive positioning, and regulatory constraints, making it the starting point where strategic direction begins. Though typically the mechanism for long-term thinking, environmental scanning can also incorporate short-term tactical adjustments from operational teams. Strategy culminates at the implementation stage, a phase designed to translate decisions into coordinated action and delegate responsibility to appropriate functions. Though strategic frameworks are traditionally depicted with clear hierarchies, vision cascading to goals, cascading to tactics, reality is more fluid, and the actual flow of strategic influence is often more complex. In most organizations, strategic plans and tactical execution are usually separated by several organizational layers. Leadership typically operates at the vision level, measuring progress in years. Middle management translates this into initiatives spanning quarters or months. Frontline teams execute daily and weekly tasks, not much different in timescale than the gap between a 5-year plan and tomorrow's to-do list. The longest strategic planning cycles run from initial concept to full market validation, a duration of several years in some industries. Much of what we understand about effective strategy has been gleaned from successful companies, prized in business literature for their consistent execution and clear positioning. Functionally, strategic elements fall into several categories. Vision and mission statements bring aspirational direction into the organizational consciousness from leadership and values. Objectives and key results carry measurable targets out to operational teams. Strategic initiatives connect vision to execution within departments. The terms strategic and tactical can also describe the time horizon of activities, with strategic referring to longer-term positioning. Strategy can also be classified by the nature of its approach. Deliberate strategy is explicitly planned and articulated, documented in formal plans, and communicated through structured channels. These include most corporate strategies and use analytical frameworks to guide resource allocation. Emergent strategy arises from operational patterns and market responses, discovered rather than designed. These are sometimes called adaptive strategies and developed through organizational learning and market feedback rather than top-down planning. Opportunistic strategy doesn't follow either planned or emergent patterns. It responds to unexpected circumstances through rapid decision-making, capitalizing on fleeting windows that systematic planning might miss. Each strategic approach, whether deliberate or emergent, serves different organizational needs. The choice depends on market stability, organizational culture, and competitive dynamics. Success often requires balancing all three modes simultaneously. Damage to strategic planning or breakdown in the connection between strategy and operations can produce failures ranging from slow drift into irrelevance to sudden competitive collapse. Strategic misalignment manifests in various ways. Departments working at cross purposes, resources deployed to low-impact initiatives, talent concentrated in the wrong areas, or innovation focused on features customers don't value. Headaches from strategic confusion, market position erosion, and declining financial performance may also be linked to such organizational disruption. Even when strategies are executed consistently, they can fail or become obsolete if market conditions shift faster than planning cycles allow for adjustment. The business environment does not wait for annual planning retreats. The financial management system is a resource allocation and monitoring apparatus composed of accounting, budgeting, forecasting, and capital management functions. These mechanisms serve as signals throughout the organization, traveling through departments to influence decisions which interpret the numbers and allocate accordingly. At first glance, it may seem improbable that spreadsheet entries could guide behavior across an entire organization and trigger specific responses far from the finance department. Yet this occurs continuously and quite reliably in functioning businesses. Financial metrics are responsible for maintaining viability and coordinating responses to both internal performance and external market conditions. Without them, basic business functions like pricing, investment, resource allocation, even payroll would be impossible. The financial system establishes a numerical connection from the accounting department to virtually all operations that govern spending, growth, and profitability. It produces two main categories of information: historical reporting, which tracks what has already occurred, and forward-looking forecasts, which project future performance based on assumptions. Regulation of resource allocation is typically managed through budgeting mechanisms. When departments request more resources than allocated, the system responds by requiring justification and prioritization. There are exceptions to this pattern, rapid growth phases being notable ones, but most financial activity is governed by these constraining loops. Other influences, including market conditions and competitive pressure, also help regulate spending levels. It's useful here to distinguish between accounting and finance functions. Accounting records and reports what has happened, documenting transactions either as they occur or as cash changes hands. These records are not strategic tools in themselves. In contrast, finance uses that historical data to make forward-looking decisions about resource deployment. The major activities in the financial system include transaction recording, financial statement preparation, budget development, performance analysis, and capital allocation decisions. Accounting itself, often misunderstood as mere bookkeeping, plays several roles. It tracks revenue and expenses, manages accounts receivable and payable, reconciles bank accounts, prepares tax filings, and produces financial statements. The balance sheet, consisting of assets, liabilities, and equity, sits as a snapshot of financial position at a specific moment. The income statement, tracking revenue and expenses over a period, shows profitability. The cash flow statement reveals actual money movement, which can differ substantially from accounting profit. Revenue, simply put, is the total amount customers pay for products or services. It enables one business to operate at a larger scale than another, often supporting higher fixed cost structures. This revenue, generated through sales transactions, enters the accounting system and then flows through various financial analyses to inform decisions. The job is to measure commercial activity and thereby assess viability, guide pricing, and evaluate business model sustainability. While strategy and finance both aim to guide the business forward, their methods diverge. Strategy uses qualitative vision and competitive positioning to produce directional clarity on broad initiatives. These effects, though important, take considerable time to manifest. Financial controls, in contrast, operate daily, affecting decisions continuously through budget limits and performance metrics, and their influence persists as long as the fiscal period remains active, which may be a full year. A financial metric, fundamentally, is a quantitative signal. Profit margins indicate pricing power and cost efficiency. Cash flow reveals liquidity and operational sustainability. Return on investment measures capital allocation effectiveness. Working capital ratios show short-term financial health. Each metric tells a different story, and collectively, they provide a multidimensional view of business performance. The balance sheet lists what the business owns, assets what it owes, liabilities, and the residual value belonging to owners, equity. Assets range from cash and inventory to equipment and intellectual property. Liabilities include everything from credit card balances to long-term debt. Equity represents the accounting difference between the two, though its market value may differ substantially from this book value. The income statement tracks performance over time, typically monthly, quarterly, or annually. Revenue appears at the top, often called the top line. From this, cost of goods sold is subtracted, yielding gross profit. Operating expenses like salaries, rent, and marketing are then deducted, producing operating profit, or EBITDA, earnings before interest, taxes, depreciation, and amortization. Further adjustments for financing costs and taxes arrive at net income, the bottom line. Cash flow deserves particular attention, since businesses can be profitable on paper while running out of cash, a surprisingly common failure mode. Cash flow from operations reveals whether core business activities generate or consume cash. Cash flow from investing shows capital expenditures and asset purchases. Cash flow from financing tracks debt, equity raises, and distributions to owners. A business might report strong profits, while hemorrhaging cash if customers pay slowly or inventory builds excessively. Budget development translates strategy into financial constraints. Departments submit requests, finance consolidates and pressure tests assumptions, leadership approves allocations, and monitoring systems track actual performance against plan. Variances, differences between budget and actuals, trigger investigation and potential corrective action. Forecasting attempts to predict future financial performance based on historical patterns, pipeline data, market conditions, and strategic initiatives. These projections guide hiring decisions, capital investments, and strategic pivots. However, forecasts are inherently uncertain, more so the further they extend into the future. Common financial mistakes cluster around a few themes. Confusing revenue with profit or profit with cash flow leads to poor decisions. Underestimating the capital required to reach profitability has ended countless startups. Allowing accounts receivable to balloon without collection discipline creates phantom revenue. Growing too quickly without corresponding investment in infrastructure strains operations and cash reserves. Financial literacy, the ability to read and interpret these metrics, varies considerably across organizations. Founders with technical or creative backgrounds may find financial statements opaque, delegating entirely to others. This works until it doesn't, typically when cash runs low or investors demand explanations. The numbers, while not the whole story, provide essential feedback about whether the business model actually functions as intended. Revenue generation, simply put, is how businesses convert prospects into paying customers. It's the fundamental difference between a hobby and a commercial enterprise. Though ironically, it's not required for a non-profit to generate revenue from beneficiaries, only for a for-profit venture. In the commercial version of this age-old economic ritual, two primary functions are involved: marketing, which creates awareness and demand, and sales, which closes transactions and captures value. Only through the coordinated activity of both functions does revenue actually materialize. To generate income, businesses require marketing to identify and attract potential customers, and sales to convert interest into committed purchases. Each is specialized to produce, qualify, and convert leads, though their approaches and timelines differ significantly. Marketing's activities span both inside the organization through strategy and messaging, and outside through campaigns and content. Sales activities, by contrast, are conducted almost entirely in direct engagement with prospects. The marketing function includes brand development, where positioning and identity are established, and demand generation, where prospects are identified and attracted. Marketing efforts travel through various channels: content marketing through blogs and videos, paid advertising through digital and traditional media, public relations through earned coverage, and events through conferences and webinars. Along the way, marketing contributes messaging that shapes perception and generates leads that sales can pursue. These efforts include defining target markets, segmenting customers into groups, developing value propositions, creating content, and measuring campaign performance. Marketing's primary output is leads, potential customers who have expressed some level of interest. These leads fall into categories based on qualification level. A marketing qualified lead, or MQL, has engaged enough to warrant sales attention, perhaps by downloading content or attending a webinar. This designation, though somewhat arbitrary, helps coordinate handoffs between functions. A sales qualified lead, or SQL, has been vetted by sales and deemed worthy of active pursuit. The progression from stranger to MQL to SQL to customer represents the revenue generation funnel, so named for its shape, as prospects filter through increasingly stringent qualification stages. The sales function transforms qualified interest into committed revenue. This begins with prospecting, identifying potential customers, though in many organizations, marketing handles much of this initial identification. Once prospects are identified, sales professionals conduct discovery, understanding needs and challenges. They present solutions, address objections, negotiate terms, and close deals. The sales process varies dramatically by business model, product complexity, and deal size, ranging from minutes for low-cost transactional sales to months or years for complex enterprise contracts. Sales methodologies provide frameworks for this process. Solution selling focuses on understanding customer problems before presenting products. Consultative selling positions the salesperson as advisor rather than vendor. Spin selling uses specific question sequences. Challenger selling emphasizes teaching customers new perspectives. Each approach has proponents and appropriate contexts, though none guarantees success. In practice, effective salespeople adapt their approach based on the specific customer and situation. For revenue to materialize consistently, marketing and sales must coordinate on several dimensions. Messaging alignment ensures sales conversations reinforce marketing promises rather than contradicting them. Lead quality standards prevent marketing from generating volume that sales deems worthless or sales from dismissing viable opportunities. Feedback loops allow sales to inform marketing which messages and channels actually produce closable business. Shared metrics, particularly around conversion rates and revenue attribution, maintain accountability and focus. The revenue funnel provides a framework for this coordination. At the top, marketing generates awareness among a broad audience. Moving down, prospects engage with content and express interest. Marketing qualified leads emerge from this engagement. Sales then qualifies these leads, identifying those with genuine need, budget, authority, and timeline, often abbreviated as BANT. Qualified prospects enter active sales cycles, progressing through stages like demo, proposal, negotiation, and close. At each stage, some percentage drops out while others advance, creating the characteristic funnel shape. Conversion rates measure the percentage moving from one stage to the next. A typical B2B technology company might see roughly 2 to 5% of website visitors become leads. Approximately 20 to 30% of leads qualify as SQLs, and perhaps 20 to 30% of SQLs eventually close. These percentages vary enormously by industry, deal size, and sales model. Multiplying through the funnel reveals why large top-of-funnel volumes are necessary to produce meaningful revenue, particularly for businesses with low conversion rates or small average deal sizes. Customer acquisition cost, or CAC, measures the total marketing and sales expense required to land a new customer. This includes salaries, advertising spend, software tools, and overhead. A software company spending $100,000 monthly on marketing and sales while acquiring 20 customers has a CAC of $5,000. This metric only becomes meaningful in relation to customer lifetime value, the total profit a customer generates over their entire relationship with the business. A customer paying $500 monthly for software with 70% gross margins over an average lifetime of 36 months generates roughly $12,600 in lifetime value, yielding a ratio of 2.5 to 1. Sustainable businesses typically target ratios of 3 to 1 or higher, ensuring the customer eventually pays back acquisition costs with profit to spare. Different business models employ different revenue generation approaches. Transactional sales, common in retail and e-commerce, involve relatively low-value purchases with minimal relationship building. The sales cycle might last minutes and rely heavily on product availability, pricing, and convenience. Relationship sales, typical in B2B contexts, require extended engagement to build trust and understand complex needs. Enterprise sales adds additional complexity through multiple stakeholders, formal procurement processes, and lengthy legal negotiations. The distinction between B2B, business to business, and B2C, business to consumer, creates further variation. B2B sales typically involve higher deal values, longer cycles, and more rational decision-making processes, though office politics and personal preferences still influence outcomes. B2C sales tend toward higher volume, lower value transactions driven by emotional factors and impulse. B2B marketing emphasizes thought leadership, case studies, and ROI justification. B2C marketing focuses on brand, emotion, and convenience. High-touch sales models employ dedicated salespeople for each opportunity, appropriate when deal sizes justify the expense. Low-touch or self-service models minimize human involvement, relying instead on product design, pricing, and automated nurturing to drive conversion. Many businesses operate hybrid models, offering self-service options for smaller customers while assigning account executives to larger opportunities. Sales compensation structures attempt to align individual incentives with business objectives. Commission plans pay percentages of closed revenue, motivating aggressive pursuit, but potentially encouraging short-term thinking. Quota-based systems establish targets and reward achievement. Team-based compensation promotes collaboration, but may allow free riding. The optimal structure depends on sales cycle length, deal complexity, and strategic priorities. Account management extends beyond initial sale to ensure customer success, identify expansion opportunities, and prevent churn. This function, sometimes housed in sales and sometimes separated into customer success teams, maintains relationships and grows revenue from existing customers. In subscription businesses, retention and expansion often matter more than new customer acquisition, since acquiring customers only to lose them quickly destroys value. Though the machinery differs between B2B and B2C, between transactional and consultative, the fundamental goal is shared: converting market opportunity into actual revenue through the coordination of awareness building and persuasion into commercial exchange. A straightforward concept executed with a remarkable amount of process sophistication, psychological understanding, and persistent effort. The operations management system serves several essential functions. It transforms inputs into outputs, coordinates workflows, manages resources throughout production or service delivery, controls quality, and ensures consistent execution. At the core are the processes, procedures, and systems that actually create the products or services customers pay for. Operations is fundamentally about transformation. Raw materials, labor, and capital enter the system, and finished goods or completed services emerge. This transformation occurs through defined processes, sequences of activities that convert inputs to outputs in repeatable ways. A manufacturing operation transforms components into assembled products. A consulting firm transforms expertise and client information into recommendations. A restaurant transforms ingredients and culinary skill into meals. The specifics vary dramatically, but the underlying pattern of transformation remains. Process design determines how this transformation occurs. Decisions about workflow sequences, task allocation, quality checkpoints, and capacity constraints all fall within operations. Well-designed processes minimize waste, reduce cycle time, maintain quality, and scale efficiently. Poorly designed processes create bottlenecks, generate defects, frustrate workers, and limit growth. The difference between these outcomes often comes down to deliberate process thinking, rather than allowing workflows to emerge organically through habit and improvisation. Standard operating procedures, or SOPs, document these processes in sufficient detail that someone unfamiliar with the work could follow them to produce consistent results. These written procedures serve multiple purposes: training new employees, maintaining quality during absences, identifying improvement opportunities, and ensuring compliance with regulations. Organizations with mature operations maintain libraries of SOPs covering everything from routine tasks to emergency responses. Those without such documentation rely on tribal knowledge that walks out the door when employees leave. Quality control focuses on detecting defects before they reach customers. This typically involves inspection at key points in the production process, testing finished goods, and measuring output against specifications. Quality assurance, by contrast, aims to prevent defects by designing robust processes and building quality into workflows rather than inspecting it in afterward. The distinction matters because inspection catches problems but doesn't prevent them, while process improvement reduces their occurrence. Operational metrics provide visibility into performance. Throughput measures units produced per time period, revealing capacity utilization. Cycle time tracks duration from start to finish, highlighting bottlenecks. Defect rates quantify quality issues. First pass yield shows the percentage completing the process without requiring rework. On-time delivery measures schedule reliability. These metrics, when tracked consistently, expose problems and validate improvements. Capacity management balances available resources against demand. Underutilized capacity wastes money on idle equipment and labor. Overutilized capacity creates delays, quality problems, and employee burnout. Manufacturing operations manage capacity through production scheduling, inventory buffers, and capital investment in additional equipment. Service operations, unable to inventory their output, must carefully match staffing to demand patterns or accept either idle time during slow periods or service delays during peaks. Inventory management presents particular challenges for product businesses. Too much inventory ties up cash and risks obsolescence. Too little creates stockouts and lost sales. Just-in-time approaches minimize inventory by coordinating closely with suppliers to deliver materials exactly when needed, reducing carrying costs but increasing vulnerability to supply disruptions. Just-in-case approaches maintain buffer inventory to absorb demand variability and supplier delays, trading carrying costs for operational flexibility. Continuous improvement methodologies provide frameworks for incremental operational enhancement. Lean principles focus on eliminating waste, defined as any activity that doesn't add value from the customer's perspective. Six Sigma emphasizes reducing process variation through statistical analysis and controlled experimentation. Kaizen promotes small, frequent improvements driven by frontline workers. Theory of constraints identifies and addresses the single biggest bottleneck limiting system performance. Each methodology has devotees and appropriate applications, though they share an underlying commitment to systematic improvement rather than accepting current performance as inevitable. The distinction between manufacturing and service operations creates different optimization priorities. Manufacturing produces tangible goods that can be inventoried, inspected before delivery, and standardized through automation. Service operations produce intangible experiences that occur during customer interaction, cannot be stored, and require human judgment. A factory can build inventory during slow periods to smooth production. A restaurant cannot prepare meals in advance for eventual customers. This fundamental difference shapes operational strategy, with manufacturing prioritizing efficiency and standardization, while services balance efficiency against flexibility and personalization. Operational failures manifest in various ways. Quality problems damage reputation and trigger costly recalls or rework. Capacity constraints limit revenue regardless of demand. Process bottlenecks create delays throughout the system. Supply chain disruptions halt production. Equipment failures create unplanned downtime. Each problem typically stems from inadequate planning, insufficient investment, or gradual degradation of processes that once functioned adequately. Scaling operations presents particular challenges. Processes that worked at small volume often break at larger scale. Quality control that relied on founder attention to every detail becomes impossible when volume grows. Production bottlenecks emerge where previously there was sufficient slack. Supplier relationships that provided adequate capacity cannot meet expanded requirements. Successfully scaling operations typically requires systematic process documentation, quality systems, capacity investment, and supply chain development well before current capabilities reach their limits. Operations excellence plays a central role in competitive positioning and profitability. Between 60 and 70% of customer satisfaction often derives from operational execution rather than product features or marketing promises. Reliability, quality, and timely delivery all depend on operational capability. As businesses mature, operational sophistication frequently lags behind growth ambitions, creating mounting quality problems, delivery delays, and customer dissatisfaction that constrain further expansion. The human resources system is a coordination apparatus between the organization and its people. While leadership is responsible for setting strategic direction, HR manages the practical mechanisms of talent acquisition, development, and retention. It's a partnership that transforms individual capabilities into organizational capacity. Talent acquisition begins with workforce planning, determining what roles are needed and when. Job descriptions define responsibilities, required skills, and reporting relationships. Recruiting sources candidates through various channels: job postings, referrals, recruiting agencies, and direct outreach. Screening filters applicants based on qualifications. Interviews assess fit across multiple dimensions, including skills, cultural alignment, and long-term potential. Reference checks validate claims and uncover issues. Offers formalize terms including compensation, benefits, and start dates. Onboarding integrates new hires into the organization. This extends beyond paperwork and orientation to include training on systems, introduction to colleagues, and clarity around expectations. Poor onboarding creates confusion and increases early turnover. Effective onboarding accelerates productivity and builds connection to the organization. The difference often determines whether new hires thrive or struggle, yet many organizations treat it as an administrative afterthought rather than a strategic process. Performance management attempts to align individual effort with organizational objectives. This typically involves setting goals, providing feedback, conducting formal reviews, and linking performance to consequences like raises, promotions, or termination. In theory, this creates accountability and motivates improvement. In practice, performance management often becomes a bureaucratic exercise that managers dread and employees game. The challenge lies in making evaluation genuinely developmental rather than merely judgmental, and in maintaining fairness while acknowledging that performance assessment involves substantial subjectivity. Compensation structures balance internal equity, external competitiveness, and budget constraints. base salaries provide stable income, bonuses reward achievement of specific objectives, equity grants, where offered, align employee and shareholder interests while conserving cash. Benefits including health insurance, retirement contributions, and paid time off comprise significant portions of total compensation, often 20 to 40% above base salary. Getting compensation right matters because underpaying drives attrition, while overpaying strains finances without necessarily improving performance. Organizational structure defines reporting relationships and decision rights. Functional organizations group people by specialty: engineering, marketing, sales, operations. This creates expertise depth, but can produce silos where departments optimize locally while the overall business suffers. Matrix organizations assign people to both functional managers and project or product teams, theoretically combining specialization benefits with cross-functional coordination. In practice, matrix structures often create confusion about priorities and accountability. Flat organizations minimize hierarchy, promoting autonomy and speed, but potentially creating role ambiguity and limiting advancement opportunities. Span of control, the number of direct reports per manager, shapes organizational structure. Narrow spans, perhaps 3 to 5 reports, enable close supervision, but create tall hierarchies with many management layers. Wide spans, potentially 10 or more reports, require manager delegation and employee autonomy, but risk inadequate oversight. The appropriate span depends on work complexity, employee experience, and management capability. Culture, though harder to define than structure, profoundly influences organizational effectiveness. It encompasses shared values, behavioral norms, communication patterns, and unwritten rules about how work actually gets done. Strong cultures provide coordination without extensive formal controls, reducing need for detailed policies and constant supervision. However, strong cultures can also resist necessary change and exclude those who don't fit established patterns. HR failures produce consequences ranging from individual dissatisfaction to systematic organizational dysfunction. High turnover disrupts operations and drains resources. Poor hiring decisions place incompetent or misaligned people in critical roles. Inadequate development leaves the organization without needed capabilities. Compensation misalignment demotivates performers or creates unsustainable cost structures. Structural problems create turf battles, duplicated efforts, or coordination failures. With multiple employees working in coordination, alignment becomes critical. Each person must understand their role and how it connects to organizational objectives. When alignment breaks down, effort dissipates into conflicting priorities and redundant work, undermining even diligent individual contributions. The legal and compliance system serves as both a detector of regulatory requirements and a regulator of operational boundaries. It accomplishes these functions through policies, procedures, and monitoring mechanisms that respond to both internal activities and external regulatory changes. These structures reside primarily in legal counsel, compliance officers, and risk management functions, though their influence extends throughout the organization. Legal structure forms the foundation, determining how the business entity exists in the eyes of law and tax authorities. Sole proprietorships offer simplicity but expose personal assets to business liabilities. Partnerships distribute ownership and liability among multiple parties, creating both flexibility and potential conflict. Limited liability companies, or LLCs, separate business and personal liability while allowing tax treatment flexibility. Corporations provide the strongest liability protection and enable equity financing, but impose more regulatory burden and potential double taxation. S corporations blend some corporate benefits with pass-through taxation, though with ownership restrictions. The choice among these structures affects taxation, liability exposure, fundraising capability, and administrative complexity. Intellectual property protection attempts to create defensible, competitive advantages from intangible assets. Patents protect inventions and novel processes, granting temporary monopolies in exchange for public disclosure. Trademarks protect brand identifiers like names and logos. Copyrights cover creative works. Trade secrets protect confidential information through access controls rather than public registration. Each protection mechanism involves different processes, costs, and strategic considerations. Technology companies often build patent portfolios both for genuine protection and as bargaining chips in potential disputes. Consumer brands invest heavily in trademark protection to prevent dilution. Many businesses, however, underinvest in IP protection until threatened by competitors, at which point establishing rights becomes considerably more difficult. Contracts govern relationships with customers, suppliers, employees, and partners. These written agreements establish expectations, allocate risks, and provide remedies for breach. Standard terms and conditions reduce negotiation burden for routine transactions. Custom contracts address unique situations and larger commitments. Employment agreements cover compensation, responsibilities, termination conditions, and often include non-compete and confidentiality provisions. Partnership and supplier contracts define scope, pricing, service levels, and liability limitations. Customer contracts specify deliverables, payment terms, and warranties. Poor contract management creates exposure when terms aren't honoured or disputes arise about interpretation. Liability management addresses the various ways businesses might be held responsible for harm. Product liability covers injuries from defective products. Professional liability, also called errors and omissions coverage, protects service providers from claims of negligence or inadequate work. General liability covers routine business risks like customer injuries on premises. Officers and directors face potential personal liability for decisions made on behalf of the company. Insurance transfers some of these risks to third parties in exchange for premiums, though coverage always includes exclusions and limitations. Regulatory compliance varies dramatically by industry and geography. Financial services face extensive regulation covering capital requirements, disclosure, customer protection, and transaction monitoring. Healthcare providers navigate complex rules around privacy, billing, and clinical standards. Food businesses comply with safety and labeling requirements. All businesses face employment law covering wages, discrimination, safety, and benefits. Tax compliance alone demands attention to income taxes, payroll taxes, sales taxes, and various local obligations, each with different filing requirements and deadlines. Data protection and privacy have emerged as significant compliance challenges, particularly for businesses operating across jurisdictions. The European Union's General Data Protection Regulation, or GDPR, imposes strict requirements on collecting, processing, and storing personal data, with substantial penalties for violations. California's Consumer Privacy Act creates similar obligations within that state. Other jurisdictions continue adding their own requirements. Compliance demands understanding what data is collected, where it's stored, who accesses it, how long it's retained, and whether appropriate security protects it. Risk management extends beyond legal compliance to identify and mitigate various operational and strategic threats. Risk assessment systematically examines what could go wrong, the likelihood of each scenario, and potential impact. Common business risks include market shifts that undermine the business model, competitive threats that erode positioning, operational failures that disrupt delivery, financial risks like currency fluctuations or credit exposure, and reputational damage from negative publicity. Mitigation strategies include avoiding risky activities entirely, transferring risk through insurance or contracts, reducing likelihood or impact through controls, or accepting some level of risk as the cost of doing business. Business continuity planning prepares for severe disruptions like natural disasters, cyber attacks, or key personnel losses. These plans identify critical functions, establish backup systems, define communication protocols, and test recovery procedures. Most businesses, particularly smaller ones, operate without adequate continuity plans until a crisis exposes the gap. Non-compliance or inadequate risk management produces consequences ranging from minor fines to business failure. Regulatory violations trigger penalties that can reach millions of dollars for serious or repeated offences. Litigation exposes businesses to potentially unlimited damages and forces expensive legal defence regardless of merit. Reputational damage from public legal problems can erode customer trust and employee morale. Operational disruptions from unmanaged risks halt revenue while costs continue. Criminal liability for serious violations can result in imprisonment of responsible individuals. Legal and risk management represents a function maintained by organizational boundaries. It allows businesses to operate with confidence without crossing regulatory lines. Though some companies, particularly in heavily regulated industries, navigate these constraints with notably more sophistication than others. A reminder that businesses are built for profit, not litigation. Customer relationships are the first connection to develop in a business, and among the last to fade before dissolution. They represent the most direct link to revenue, and fittingly, the most critical driver of long-term sustainability. With roughly a dozen or more touchpoints per customer journey, and approximately millions of potential interactions across a customer base, the relationship infrastructure is not only essential to commercial viability, it's also among the most complex to manage effectively. Customer service handles reactive support, responding to problems, questions, and complaints. Support channels include phone, email, chat, and increasingly automated systems. Response systems determine how quickly and effectively issues are addressed. Service level agreements, or SLAs, establish commitments around response times and resolution rates. Issue resolution processes define escalation paths and decision rights for common problems. The goal is straightforward: resolve customer problems efficiently while maintaining satisfaction. Customer success takes a more proactive approach, particularly in subscription businesses where ongoing value delivery determines retention. Success programs monitor usage patterns, identify customers at risk of churning, and intervene with training, optimization suggestions, or product adjustments. Account management maintains regular communication with key customers, understanding their evolving needs and identifying expansion opportunities. The distinction between reactive support and proactive success matters because waiting for customers to complain often means discovering problems too late to prevent churn. Retention mechanisms attempt to keep customers engaged and reduce churn, the percentage who stop buying or cancel subscriptions. Satisfaction measurement through surveys and feedback provides early warning of problems. Net Promoter Score, asking how likely customers are to recommend the business, has become a common though somewhat controversial metric. Churn prevention identifies at-risk customers through usage patterns, payment issues, or support ticket frequency. Loyalty. Programs reward continued patronage, though their effectiveness varies widely. The customer journey includes multiple touchpoint types, each requiring different capabilities. Pre-sale touchpoints, like marketing content, sales conversations, and demonstrations shape initial impressions. Point-of-sale interactions including pricing negotiations, contract signing, and onboarding set expectations for the relationship. Post-sale touchpoints through support, training, and account management determine whether customers realize value and remain engaged. Some interactions involve human contact, while others rely on automated systems. Reactive touchpoints respond to customer-initiated contact, while proactive touchpoints reach out based on business objectives or customer needs. Customer acquisition costs and retention costs differ substantially. Acquiring new customers typically costs 5 to 25 times more than retaining existing ones, though specific ratios vary by industry and business model. This asymmetry explains why mature businesses increasingly focus on retention and expansion rather than pure new customer acquisition. Lifetime value calculations, projecting total profit from a customer relationship, guide decisions about how much to invest in both acquisition and retention. Together, these customer relationship systems give rise to the overall experience, allowing businesses not only to transact but to build loyalty, gather market intelligence, and respond effectively to evolving customer needs. The supply chain and logistics system is essential to delivering products and maintaining operational flow. Continuously moving materials, goods, and information while also managing waste and inefficiency. It helps coordinate timing, manages inventory levels, and supports countless operational processes. When this system falters, often from supplier failures or logistical breakdowns, the results are serious. Stockouts and missed deliveries remain common causes of customer dissatisfaction and lost revenue. While the supply chain technically includes supplier relationships, internal operations, inventory management, and distribution networks, it often serves as shorthand for the entire material flow, orchestrating product availability. In practice, supply chain and logistics are frequently used interchangeably, though strictly speaking, logistics refers specifically to the physical movement and storage of goods. Supplier relationships form the foundation. Procurement identifies and evaluates potential suppliers based on capability, reliability, pricing, and strategic fit. Supplier selection balances cost against quality, delivery, reliability, and risk. Single sourcing concentrates volume with one supplier, maximizing leverage and simplifying coordination, but creating vulnerability to disruption. Multi-sourcing distributes purchases across several suppliers, reducing dependency but complicating management and potentially raising costs. Strategic partnerships involve deep collaboration and information sharing, while transactional relationships treat suppliers as interchangeable vendors competing primarily on price. Inventory management presents persistent challenges. Holding costs including warehousing, insurance, obsolescence, and capital tied up in stock argue for minimal inventory. Stockout costs from lost sales, expediting fees, and customer dissatisfaction argue for generous buffers. The tension between these forces shapes inventory strategy. Economic order quantity calculations attempt to optimize order sizes by balancing ordering costs against holding costs. Reorder points establish inventory levels, triggering replenishment. Safety stock provides buffers against demand variability and supply uncertainty. Just-in-time inventory systems minimize stock by coordinating production with demand and supplier deliveries. This approach, pioneered in Japanese manufacturing, reduces holding costs and reveals process problems that excess inventory might hide. However, it demands reliable suppliers, accurate demand forecasting, and robust coordination. Supply disruptions that would be minor inconveniences with inventory buffers become production-stopping crises under just-in-time. Just-in-case approaches maintain larger safety stocks, trading higher holding costs for operational resilience. Warehousing and storage provide physical locations for inventory. Distribution centers near major markets enable rapid delivery. Cross-docking facilities transfer goods directly from inbound to outbound shipments without intermediate storage, minimizing handling. Warehouse management systems track inventory location, optimize picking routes, and coordinate inbound and outbound flows. Third-party logistics providers, or 3PLs, offer warehousing and fulfillment services, allowing businesses to avoid capital investment in facilities while potentially sacrificing control. Distribution and fulfillment translate orders into delivered products. Order processing captures customer requests, checks inventory availability, and initiates fulfillment. Picking retrieves items from warehouse locations. Packing prepares orders for shipment with appropriate protection and labeling. Shipping selects carriers, arranges pickup, and provides tracking information. Last-mile delivery, the final leg to customer locations, often represents the most expensive and complex portion of the journey. Transportation moves goods between facilities and to customers. Modal choices include truck, rail, air, and ocean, each offering different trade-offs between speed, cost, and flexibility. Truck freight provides door-to-door service and reasonable speed, but at relatively high cost per ton-mile. Rail efficiently moves bulk goods over long distances, but requires access to rail infrastructure. Air freight enables rapid delivery across continents, but costs substantially more. Ocean shipping moves large volumes economically, but slowly. Most complex. Supply chains employ multiple modes, transferring goods between them at intermodal facilities. Lead times, the duration from order placement to delivery, shape customer expectations and inventory requirements. Manufacturing lead times cover production duration. Supplier lead times span ordering to receipt of materials. Delivery lead times measure shipment duration. Cumulative lead times from raw material order to customer delivery can stretch weeks or months in complex global supply chains. Reducing lead times improves responsiveness and reduces inventory requirements, but often demands premium transportation, local suppliers, or simplified products. Supply chain metrics provide visibility into performance. On-time delivery measures schedule reliability, typically targeting 95% or higher. Order fulfillment accuracy tracks error rates in picking, packing, and shipping. Inventory turnover, calculated as cost of goods sold divided by average inventory, reveals how efficiently inventory converts to sales. Days of inventory indicates how long current stock would last at current sales rates. Cash-to-cash cycle time measures the period from paying suppliers to collecting from customers, a critical metric for working capital management. Demand forecasting attempts to predict future needs, enabling proactive supply chain positioning. Statistical methods extrapolate from historical patterns. Collaborative planning incorporates customer forecasts and market intelligence. Forecast accuracy determines inventory levels, supplier commitments, and capacity planning. Forecast errors in either direction create problems. Underestimates produce stockouts, while overestimates generate excess inventory. Supply chain disruptions manifest in various forms. Supplier failures from bankruptcy, quality problems, or capacity constraints interrupt material flow. Transportation delays from weather, equipment failures, or labor actions prevent timely delivery. Demand spikes beyond forecasts, deplete inventory. Quality defects in supplied materials force production stops or costly rework. Natural disasters, geopolitical events, or pandemics can simultaneously impact multiple suppliers and transportation networks, exposing vulnerabilities in extended global supply chains. In its entirety, the supply chain system is a vast, often invisible network, one that, though frequently taken for granted, works continuously to keep products flowing from sources to customers. The technology and systems infrastructure is indispensable to modern business operations. It ensures that information flows through the organization and enables automation of routine tasks. With each transaction, whether processed manually or automatically, a coordinated effort of software, hardware, and data moves information to and from various functions. The path of this information flow is managed through the technology stack, which divides into several layers. The infrastructure layer includes servers, networks, and cloud computing platforms that provide basic computing capacity. The application layer comprises the software tools that employees use for specific tasks. The data layer stores and organizes information for retrieval and analysis. The security layer protects all of these from unauthorized access and malicious attacks. Information is captured, processed, and distributed as it travels through these systems. This begins with data entry points, where transactions, customer interactions, and operational events are recorded. Inside the application layer, business logic processes this information according to defined rules. Specialized systems handle different functional needs. Customer Relationship Management, or CRM, platforms track sales pipelines, customer interactions, and support tickets. Enterprise Resource Planning, or ERP, systems integrate financial, inventory, and operational data. Project management tools coordinate work across teams. Communication platforms enable messaging, video calls, and file sharing. From the application layer, processed information flows to reporting and analytics tools that transform raw data into actionable insights. Dashboards visualize key metrics. Reports summarize performance across time periods and business units. Analytics platforms identify patterns and trends that inform decision-making. The technology stack also includes communication and collaboration infrastructure. Email remains ubiquitous despite its limitations. Instant messaging enables rapid exchanges. Video conferencing approximates in-person meetings. Document collaboration tools allow multiple people to work on the same files simultaneously. These systems, collectively called the digital workplace, largely replaced physical proximity as the primary coordination mechanism for knowledge work, a shift accelerated substantially by remote work adoption. E-commerce and digital platforms extend business capabilities beyond physical constraints. Online storefronts enable 24/7 purchasing. Payment processing systems handle transactions securely. Inventory management systems sync across channels. Customer portals provide self-service access to account information. API integrations connect different systems, allowing data to flow automatically between platforms without manual data entry. Data management presents ongoing challenges. Businesses accumulate vast quantities of information from transactions, customer interactions, operational sensors, and external sources. This data resides in databases, data warehouses, and increasingly in data lakes that store structured and unstructured information together. Organizing this data for efficient retrieval and analysis requires database design, data modeling, and governance policies that define who can access what information and how it can be used. Security and access control protect systems from threats and ensure appropriate information access. Authentication verifies user identity through passwords, multi-factor authentication, or biometric verification. Authorization determines what authenticated users can do within systems. Encryption protects data during transmission and storage. Firewalls filter network traffic. Intrusion detection systems monitor for suspicious activity. Despite these defenses, security breaches remain common, with consequences ranging from minor inconveniences to catastrophic data losses and regulatory penalties. Technology failures produce immediate operational impacts. System outages halt work dependent on those systems. Data corruption destroys information and forces recovery from backups, assuming backups exist and function properly. Performance degradation slows work without completely stopping it, often going unaddressed until cumulative productivity losses force attention. Integration failures break connections between systems, requiring manual workarounds. Security breaches expose sensitive information, damage reputation, and trigger regulatory investigations. Technology investment decisions balance capability needs against budget constraints. Businesses typically spend somewhere between 3 and 8% of revenue on technology, though percentages vary widely by industry and growth stage. Technology-native companies may spend considerably more, while traditional businesses often underinvest relative to digital competitors. These investments cover software licenses, hardware purchases, cloud computing costs, technology staff, and external consulting or development services. The build versus buy decision shapes technology strategy. Building custom solutions offers precise fit to specific needs and potential competitive differentiation, but demands significant time and ongoing maintenance. Buying commercial software provides immediate functionality and vendor support, but requires adapting business processes to software constraints and accepting that competitors likely use similar tools. Beyond enabling operations and facilitating communication, technology infrastructure helps businesses scale, defends against competitive pressure, and contributes to efficiency through automation. The ability to implement, maintain, and evolve these systems often determines whether businesses can grow beyond the capacity of manual processes and personal relationships. The competitive intelligence and market adaptation system is the business's environmental awareness infrastructure, a vigilant and often underappreciated guardian against a world teeming with competitive threats. It operates through two main strategies: reactive intelligence and proactive adaptation. Reactive intelligence, also called market monitoring, doesn't differentiate among information sources. It's essentially continuous surveillance of the competitive landscape. This broad-spectrum awareness gathers data regardless of immediate relevance, working to detect threats and identify opportunities. It includes monitoring competitor activities, tracking market trends, collecting customer feedback, and analyzing industry developments. The process of environmental scanning provides the raw material for strategic decisions. Market monitoring relies on multiple information sources. Competitive analysis examines rival companies, their products, pricing, marketing approaches, and strategic moves. This goes beyond casual observation to systematic tracking of competitor announcements, hiring patterns, patent filings, and customer reviews. Market research investigates broader trends, including customer preferences, demographic shifts, economic conditions, and technological developments. Industry analysis focuses on structural factors like supplier power, buyer power, threat of substitutes, barriers to entry, and competitive rivalry, often organized using frameworks like Porter's Five Forces. Customer feedback systems capture direct input about satisfaction, unmet needs, and emerging requirements. Support tickets reveal common problems. Sales teams report objections and competitor comparisons they encounter. User research through interviews and surveys provides deeper insight into motivations and pain points. Social media monitoring tracks brand sentiment and identifies emerging issues. These various channels, collectively called Voice of the Customer programs, transform scattered opinions into actionable intelligence. Signal detection separates meaningful patterns from background noise. Most environmental data consists of irrelevant information, minor fluctuations, or false alarms. Distinguishing genuine threats and opportunities from distractions requires analytical frameworks, pattern recognition, and judgment. Weak signals, subtle indicators of emerging trends, often get overlooked amid louder but less significant developments. By the time threats become obvious, response options may be limited. Analysis frameworks impose structure on ambiguous information. SWOT analysis categorizes factors as strengths, weaknesses, opportunities, or threats. Scenario planning explores multiple plausible futures. Trend analysis extrapolates from historical patterns. Benchmarking compares performance against competitors or industry standards. Each framework emphasizes different aspects and risks missing factors outside its focus. Intelligence distribution ensures relevant information reaches decision makers. Competitive intelligence teams often struggle with this challenge. Executives may ignore reports they don't trust or understand. Operational teams may not receive intelligence that could inform their work. Timing matters too, since stale intelligence loses relevance, while premature warnings get dismissed as speculation. Adaptation mechanisms translate intelligence into action. Product iterations address customer feedback and competitive gaps. Strategy adjustments realign positioning or target markets. Pricing changes respond to competitive pressure or demand signals. Business model pivots fundamentally alter how value is created or captured. The magnitude of change varies from minor tweaks to complete transformation. Different threat types demand different responses. Direct competition from similar products or services typically triggers incremental improvements, pricing adjustments, or marketing emphasis on differentiation. Substitute products that solve customer problems differently may require more fundamental innovation or repositioning. Market shifts from changing customer preferences, demographic changes, or economic conditions often necessitate strategy adjustments. Technology disruption that enables new approaches or undermines existing ones sometimes forces business model reinvention. Regulatory changes alter competitive dynamics and may create opportunities or eliminate existing approaches. Response speed shapes competitive outcomes. Fast followers quickly replicate competitor innovations, minimizing first-mover advantages. Fast adapters pivot in response to market signals, maintaining relevance despite environmental changes. Slow responders allow competitors to establish dominant positions or miss opportunities entirely. However, excessive responsiveness creates its own problems, chasing every trend without strategic coherence or abandoning approaches before they fully develop. Quite the multitasker. Adaptation failures produce consequences ranging from gradual market share erosion to sudden obsolescence. Ignoring competitive threats allows rivals to capture customers and talent. Misreading market trends leads to products nobody wants. Dismissing disruptive innovations enables new entrants to undermine established businesses. Responding too late transforms minor adjustments into desperate transformations attempted from positions of weakness. Shifting to proactive adaptation, also known as strategic innovation, businesses move from reactive monitoring to anticipatory positioning. This system not only identifies current competitive dynamics, but anticipates future market developments, launching preemptive initiatives before threats fully materialize or opportunities become obvious to competitors. Which function is the most important in a business? It's a common debate, often reduced to a contest between sales and product, but rarely does anyone nominate leadership and culture, even though they span every department and play a role so central to performance that their failure can precipitate a slow unraveling of competitive position. Indeed, in many cases, the beginning of the end can be traced not to market conditions or product inadequacies, but to cultural dysfunction or leadership failures. Leadership provides several essential functions. Vision setting establishes direction and purpose, answering why the organization exists and where it aims to go. Decision-making allocates attention and resources among competing priorities, determining what gets done and what gets deferred or abandoned. Resource allocation translates decisions into budget commitments, headcount, and strategic investments. Change management guides organizations through transitions, whether incremental improvements or fundamental transformations. Without effective leadership, even talented teams with solid strategies struggle to coordinate effort towards shared objectives. Culture encompasses the largely unwritten rules governing organizational behavior. Values define what matters, what behaviors are celebrated, and what actions are discouraged. Norms establish acceptable conduct around everything from meeting punctuality to email response times to work-life boundaries. Communication patterns determine what information flows where, how transparent discussions are, and whether bad news travels up the hierarchy or gets suppressed. Decision-making styles shape whether choices are made centrally or distributed, whether consensus is sought or authority exercised, whether data drives decisions or intuition prevails. Performance expectations set the bar for acceptable work and define whether mediocrity is tolerated or excellence demanded. Strong cultures create alignment without extensive formal controls. When everyone understands and accepts cultural norms, coordination happens implicitly rather than through detailed policies and constant supervision. However, strong cultures also resist necessary adaptation and can exclude those who don't naturally fit established patterns, potentially limiting diversity of thought and background. Governance mechanisms provide formal oversight and accountability. Boards of directors in companies with such structures represent shareholders and oversee management performance. They approve major decisions, evaluate executive performance, ensure financial integrity, and provide strategic guidance. Management structures establish hierarchies and reporting relationships. Accountability systems define who is responsible for what outcomes and what consequences follow from success or failure. Ethical frameworks articulate principles for navigating difficult situations where legal compliance doesn't provide clear guidance. The relationship between formal governance and informal culture shapes organizational effectiveness. Governance provides structure and accountability, but can become bureaucratic and slow. Culture enables rapid coordination, but risks groupthink and resistance to change. The most effective organizations maintain productive tension between these forces rather than allowing either to dominate completely. Leadership failures manifest in various ways. Vision vacuum leaves organizations without direction, reacting to circumstances rather than pursuing coherent strategies. Decision paralysis prevents timely choices, allowing opportunities to pass and problems to fester. Micromanagement undermines delegation and development. Inconsistency between stated values and leadership behavior breeds cynicism. Poor communication creates confusion and misalignment. Cultural problems are often harder to diagnose but equally damaging. Toxic cultures drive away talented people and attract those willing to tolerate dysfunction. Risk-averse cultures stifle innovation and entrepreneurship. Political cultures reward maneuvering over performance. Entitled cultures resist necessary changes and accountability. The leadership and culture system itself includes both the formal governance structures that establish authority and the informal norms that guide daily behavior, with the former providing the framework and the latter determining whether that framework actually shapes organizational action. The growth and scaling system is the organizational capacity expansion engine. Though not as immediately visible as revenue generation, nor as continuously active as daily operations, it is essential all the same. In commercial ventures, this system operates under the guidance of strategy, though some aspects, such as organic growth from satisfied customers, can occur somewhat autonomously without explicit growth programs. Growth types fall into several categories, each with distinct characteristics and requirements. Organic growth expands revenue from existing products and markets through increased customer acquisition, higher retention rates, expanded usage among current customers, or price increases. This represents the most sustainable growth but typically proceeds more slowly than alternatives. Market expansion extends existing products into new geographic regions, customer segments, or distribution channels, requiring investment in market development but building on proven offerings. Product expansion adds new products or features, either extending current lines or entering adjacent categories, demanding product development capability and often straining operational systems built for narrower offerings. Acquisition growth purchases competitors, complementary businesses, or companies with desired capabilities, providing immediate scale but introducing integration challenges. Each growth mechanism demands different organizational capabilities and carries distinct risks. Organic growth requires marketing and sales excellence, plus operational capacity to serve additional customers. Market expansion demands understanding of new customer segments and potentially different regulatory environments, product expansion tests, innovation capability, and risks diluting focus. Acquisitions require capital, integration skill, and cultural compatibility assessment. Growth rate management balances expansion ambitions against organizational capacity. Growing too slowly invites competitive vulnerability as rivals capture market share and talent. Stagnant organizations struggle to attract ambitious employees and may miss market opportunities that demand rapid scaling. However, growing too fast strains operations, dilutes culture, and exhausts cash reserves. Quality often suffers when volume outpaces capability. Customer satisfaction drops when support systems can't handle increased load. Employee burnout increases as everyone works beyond sustainable capacity, trying to keep pace with growth. The relationship between growth and profitability creates strategic tension. Rapid growth typically requires investment that depresses short-term profitability. Marketing and sales expenses rise to acquire customers. Infrastructure investments in facilities, systems, and personnel anticipate rather than follow revenue. Working capital increases as inventory and receivables grow faster than payables. These investments may generate attractive returns eventually, but the timing gap between spending and payback stresses finances. Many businesses fail not from lack of demand, but from running out of cash while scaling to meet that demand. Scaling differs from simple growth in that it increases output or capacity without proportional increases in costs or resources. A business that doubles revenue by exactly doubling all expenses is growing but not scaling. One that doubles revenue while increasing expenses by, say, 50% is scaling, improving unit economics as volume increases. Scaling mechanisms leverage fixed costs, automate processes, and standardize operations to serve more customers without proportional resource additions. Process systematization enables scaling by transforming activities from individual craft into repeatable procedures. Early-stage businesses often succeed through founder hustle and improvisation, with processes existing primarily in people's heads. This works at small scale but becomes increasingly chaotic as the organization grows. Systematization documents workflows, establishes quality standards, creates training materials, and measures performance. Though this formalization can feel bureaucratic, it's essential for consistent execution beyond the capacity of informal coordination. Technology leverage amplifies human effort, allowing organizations to serve more customers without proportional headcount increases. Automation handles routine tasks, freeing people for higher value activities. Self-service systems enable customers to accomplish tasks without staff assistance. Analytics identify patterns across larger datasets than humans could manually process. Communications platforms coordinate distributed teams, The businesses that scale most efficiently typically deploy technology aggressively to multiply organizational capacity. Team expansion provides additional capacity but introduces coordination complexity. Small teams coordinate informally through direct communication and shared understanding. As teams grow, communication overhead increases more than linearly. Information that once spread naturally through proximity requires formal channels. Decision rights that were implicit become contested. Culture that emerged organically requires deliberate transmission. Organizations that double headcount rarely double output immediately because new people need onboarding, integration, and time to reach full productivity. Infrastructure development anticipates growth rather than merely reacting to it. Facilities must accommodate future headcount. Systems must handle projected transaction volumes. Organizational structures must provide room for additional layers and specialization. Supply chains must source at larger scale. However, overbuilding infrastructure wastes capital on unused capacity, while underbuilding creates constraints that limit growth. Timing these investments requires forecasting accuracy that's difficult to achieve, creating tension between preparation and efficiency. Business model evolution adapts how value is created, delivered, and captured as markets and capabilities develop. Revenue models determine how customers pay. One-time purchases, subscriptions, usage-based pricing, freemium with premium upsells, advertising supported, and transaction fees, each create different economic dynamics and customer relationships. Delivery models define how products or services reach customers, whether through direct sales, channel partners, marketplace platforms, or hybrid approaches. These choices affect margins, growth rates, and capital requirements. Strategic pivots fundamentally alter business direction when initial approaches prove inadequate or opportunities emerge elsewhere. Customer pivots target different market segments. Problem pivots address different customer needs. Platform pivots shift from applications to infrastructure. Business architecture pivots change how value is created. Revenue model pivots alter monetization approaches. Technology pivots adopt new technical foundations. Successful pivots preserve valuable assets and capabilities while abandoning unproductive approaches, though distinguishing premature abandonment from necessary adaptation challenges even experienced entrepreneurs. Growth challenges cluster around several themes. Premature scaling invests in infrastructure and team before achieving product-market fit, burning capital without generating proportional revenue. Many startups fail this way, building sales teams before the product sells itself, or creating operational capacity before demand materializes. Cash management during growth strains working capital as inventory, receivables, and operational expenses grow faster than collections. Quality maintenance becomes difficult as volume increases, particularly if growth outpaces hiring and training. Cultural dilution weakens organizational identity as new employees join faster than culture can transmit through normal acculturation. Strategic focus disperses across too many initiatives, preventing any from receiving adequate resources to succeed. Despite their variety, all growth approaches, organic expansion, market development, product innovation, and acquisition, rely on the same fundamental mechanism: identifying opportunities where the business can create value and then deploying resources to capture that value at sustainable economics. A straightforward concept executed with varying degrees of success, substantial risk, and persistent tension between speed and sustainability. The organizational infrastructure plays a rather foundational role in business sustainability, not just literally in terms of operations support, but also in knowledge preservation and capability transfer. It is a repository for institutional knowledge and standard processes, and a framework for consistent execution. Comprising documentation systems, process frameworks, integration mechanisms, and coordination tools. The organizational infrastructure is a complex and multifunctional structure underlying everything else. Infrastructure elements come in several categories. Documentation captures knowledge in retrievable formats. Processes define workflows and decision paths. Integration mechanisms connect disparate systems and functions. Coordination tools facilitate communication and alignment. These components, while less visible than customer-facing operations, determine whether businesses can execute consistently at scale or remain dependent on individual heroics. Examining organizational infrastructure reveals several standard components. Documentation systems, the knowledge repository, are composed of policies, procedures, and reference materials that encode institutional learning. Standard operating procedures detail how recurring tasks should be executed. Knowledge bases collect solutions to common problems, answers to frequent questions, and context about why decisions were made. Training materials onboard new employees and develop capabilities. Meeting notes and decision records capture reasoning and prevent repeated debates over settled questions. Without adequate documentation, organizations lose knowledge when employees leave, repeat solved problems, and operate inconsistently across teams. Process frameworks establish how work flows through the organization. Workflow definitions map inputs, activities, decision points, and outputs for core processes like sales cycles, product development, customer onboarding, and financial closing. Approval hierarchies determine who can authorize various decisions and expenditures, preventing both bottlenecks from excessive centralization and chaos from inadequate controls. Communication protocols specify what information flows where, reducing noise while ensuring critical updates reach relevant parties. Meeting structures, including regular cadences, agendas, and decision rights, provide forums for coordination without consuming excessive time. These frameworks, though they can feel bureaucratic, enable coordination beyond the capacity of ad hoc communication. Integration mechanisms connect different organizational components. Data flows between systems allow information entered once to propagate automatically rather than requiring repeated manual entry. Shared tools and platforms provide common environments where work happens and information resides. Cross-functional coordination processes like product, launch protocols, or quarterly planning cycles align activities across departments. Liaison roles bridge organizational boundaries, whether product managers connecting engineering and customers, or program managers coordinating complex initiatives. Without effective integration, organizations fragment into silos pursuing local optimization at the expense of overall performance. Infrastructure exists in multiple forms simultaneously. Formal infrastructure includes documented policies, official org charts, approved processes, and mandated systems. This represents the organization's explicit design and carries official authority. Informal infrastructure encompasses tribal knowledge, undocumented workflows, personal relationships, and cultural norms. This reflects how work actually happens versus how it's supposed to happen. Technical infrastructure consists of software platforms, hardware systems, network connectivity, and digital tools. Social infrastructure includes relationship networks, communication channels, trust patterns, and influence structures. Effective organizations attend to all four types rather than assuming formal infrastructure alone determines organizational capability. Structural maturity evolves with organizational development. Early-stage businesses operate with minimal formal infrastructure, relying on founders' knowledge, direct communication, and improvised solutions. This enables speed but limits scale. Growth-stage businesses build systematic infrastructure to enable consistent execution across expanding teams. This improves reliability but can slow adaptation. Mature businesses maintain sophisticated infrastructure, supporting complex operations, but risk rigidity and bureaucratic overhead. The challenge at each stage involves developing adequate infrastructure for current scale without overbuilding for hypothetical future needs or ossifying around outdated approaches. Infrastructure investment competes with more visible priorities. Documentation doesn't directly generate revenue. Process improvement projects rarely carry executive urgency that sales opportunities or customer crises command. Integration work often gets deferred for feature development. Yet inadequate infrastructure eventually constrains growth and creates quality problems that become increasingly costly to fix. Organizations that postpone infrastructure development typically experience crises that force reactive investment at higher cost and greater disruption than proactive development would have required. Structurally, organizational infrastructure divides into two main regions. Operational infrastructure includes processes, tools, and documentation for daily execution, essentially the mechanisms that keep the business running. Strategic infrastructure comprises governance frameworks, decision rights, and long-term capability systems that shape organizational direction and evolution. Together, these provide both stability and adaptability, enabling consistent current performance while supporting future development. The comprehensive business ecosystem is composed of the brand, market positioning, partner network, and reputation systems. Its most visible role is differentiation. The brand acts as a signal to customers and helps establish market position, performing this function continuously and often unconsciously. Beneath the brand, the partner ecosystem connects the business to suppliers, distributors, and strategic allies, creating an integrated commercial network. Brand, fundamentally, is the set of associations customers and prospects hold about a business. It enables one company to charge different prices from another, often commanding significant premiums for functionally similar offerings. These associations, built through consistent messaging, customer experience, and accumulated interactions, enter market consciousness and then persist in memory, influencing purchase decisions and recommendations. Their job is to differentiate the business from competitors and thereby reduce price sensitivity, increase customer loyalty, and improve acquisition efficiency. Brand identity encompasses the deliberate elements businesses control. The name provides the primary identifier and carries associations that either support or undermine positioning. Visual identity, including logos, color schemes, typography, and imagery, creates recognition and conveys personality. Voice and tone shape how the brand communicates, whether formal or casual, playful or serious, expert or accessible. Messaging articulates what the business does, who it serves, and why it matters. Taglines distill positioning into memorable phrases. These elements, when consistent across touchpoints, create coherent brand impressions. Brand positioning answers four fundamental questions. Who is the target customer? What problem does the offering solve? How is it different from alternatives? Why should customers believe those claims? Positioning statements formally articulate these answers, typically in templates like, for target customer, who needs statement, our product service is category that key benefit. Unlike competitive alternative, we differentiation. Though these statements rarely appear in marketing directly, they guide all messaging and strategic choices. Differentiation strategies determine how businesses distinguish themselves. Quality differentiation emphasizes superior performance, reliability, or craftsmanship. Price differentiation appeals through lower cost or premium positioning. Feature differentiation highlights unique capabilities competitors lack. Service differentiation competes on customer experience and support. Convenience differentiation focuses on ease of acquisition and use. Status differentiation leverages aspirational associations and exclusivity. Most businesses combine multiple forms, though effective positioning typically emphasizes one or two dimensions rather than claiming superiority across all. Brand architecture organizes multiple brands within a portfolio. Monolithic or branded house strategies attach all offerings to a single master brand, maximizing brand investment efficiency but linking all products' reputations. Pluralistic or house of brands approaches maintain separate brands for different offerings, allowing targeted positioning but requiring investment in building multiple brands. Endorsed brand strategies provide master brand credibility while maintaining distinct sub-brands. The optimal architecture depends on how similar target customers are, whether offerings compete with each other, and whether association helps or hurts individual product positioning. Brand equity, the commercial value of brand associations, manifests in several ways. Customer preference makes the brand a purchase factor, independent of objective product features. Price premium allows charging more than functionally equivalent alternatives. Customer loyalty reduces churn and increases lifetime value. Acquisition efficiency improves as brand awareness and reputation lower marketing costs. Partnership appeal attracts better suppliers, distributors, and employees. Acquisition value creates asset worth beyond tangible resources. Building significant brand equity typically requires years of consistent investment and positive customer experiences, though missteps can damage it rapidly. Brand evolution balances consistency with relevance. Maintaining brand identity over time builds recognition and association strength. However, brands must also adapt to changing markets, customer preferences, and competitive dynamics. Brand refreshes update visual identity and messaging while preserving core associations. Repositioning fundamentally alters target customers or competitive frame. Rebranding creates essentially new brands, typically reserved for situations where existing associations have become liabilities. The tension between consistency and adaptation challenges brand managers continuously. Reputation management addresses how various stakeholders perceive and discuss the business. Unlike brand, which businesses actively construct through marketing, reputation emerges from stakeholder experiences and conversations partly beyond direct control. Managing reputation requires monitoring perceptions, engaging stakeholders, and shaping narratives where possible. Reputation monitoring tracks mentions, sentiment, and narratives across various channels. Media monitoring captures news coverage, blog posts, and industry publications. Social listening tools track mentions, hashtags, and conversations across social platforms. Review aggregation compiles ratings and comments from customer review sites. Industry surveys measure reputation among business buyers and partners. Investor sentiment gauges financial community perception. Employee platforms like Glassdoor reveal internal reputation. These diverse signals, collectively called brand listening or reputation intelligence, provide early warning of reputation issues and validate reputation initiatives. Crisis management responds to events threatening reputation. Crises range from product failures and security breaches to executive misconduct and customer confrontations captured on social media. Crisis response protocols establish decision, authority, communication chains, and approval processes for urgent situations where delays amplify damage. Holding statements acknowledge situations while buying time to investigate. Substantive responses explain what happened, accept appropriate responsibility, outline corrective actions, and commit to prevention. Post-crisis follow-through demonstrates commitment beyond immediate damage control. Organizations that handle crises will often emerge with enhanced reputation for transparency and accountability, while those that deny, deflect, or delay typically suffer lasting damage. Public relations functions proactively shape reputation through media relationships, thought leadership, and strategic narratives. Media relations cultivate relationships with journalists covering relevant industries, providing access, background information, and expert perspectives. Press releases announce developments and frame narratives. Media training prepares spokespeople for interviews. Thought leadership establishes executives as industry authorities through articles, speaking engagements, and participation in industry discussions. Awards and recognition programs generate positive coverage and third-party validation. Community involvement builds goodwill through charitable activities and local engagement. Social proof mechanisms leverage customer voices to build trust. Customer testimonials feature satisfied customers describing their experiences. Case studies document specific implementations and results. User reviews provide unfiltered customer perspectives, with authenticity mattering more than uniformity of praise. Analyst reports from industry research firms offer third-party validation. Certifications and compliance badges signal adherence to standards. Media mentions and awards convey recognition. Social proof works because prospective customers trust peer experiences more than vendor claims, making authentic, positive customer voices more persuasive than any marketing message. Partnership ecosystems extend capabilities beyond organizational boundaries. Strategic partnerships provide mutual benefits to both parties, whether through technology integration, market access, shared development, or complementary capabilities. These relationships exist on a spectrum from transactional exchanges to deeply integrated collaborations. Supplier relationships provide materials, components, or services required for operations. Transactional supplier relationships focus primarily on price and delivery, treating suppliers as interchangeable vendors. Preferred supplier relationships concentrate volume with select partners, gaining priority and better terms. Strategic supplier relationships involve collaboration on quality, innovation, and mutual improvement. Supplier relationship quality affects not just procurement costs, but also innovation capability, quality consistency, and supply chain resilience. Distribution partnerships extend market reach through intermediaries. Resellers purchase and resell products, taking inventory risk and adding value through local market knowledge, sales relationships, and integration services. Affiliates promote offerings through content and links, earning commissions on referred sales. Marketplace platforms provide infrastructure for transactions between sellers and buyers. Distributors manage inventory, logistics, and local market relationships across geographic regions. Channel conflict arises when distribution partners compete with each other or with direct sales, requiring careful channel management and differentiated positioning. Technology partnerships integrate systems and share data. Integration partnerships connect applications through APIs, enabling data flow and coordinated functionality. Platform partnerships build on top of technology platforms like cloud providers, app stores, or operating systems. Development partnerships collaborate on new capabilities, sharing risk and combining expertise. Open source partnerships contribute to and benefit from shared code bases. These partnerships create network effects where ecosystem value attracts more participants, though managing technical interdependencies across organizations introduces complexity. Co-marketing partnerships share audience access and marketing costs. Joint webinars or events combine audiences. Content collaboration produces resources featuring both parties. Bundled offerings package complementary products or services. Cross-promotion exposes each partner's audience to the other's offerings. Effective co-marketing reaches audiences neither partner could efficiently access alone, while providing more complete solutions than either offers independently. Partnership governance establishes rules for collaborative relationships. Formal agreements define scope, obligations, revenue sharing, intellectual property rights, and termination conditions. Service-level agreements specify performance expectations and remedies for shortfalls. Joint governance bodies coordinate strategy and resolve disputes. Regular business reviews assess partnership health and identify improvement opportunities. Clear governance prevents misalignment and conflict while enabling productive collaboration. Partnership success requires ongoing management. Partner enablement provides training, tools, and resources partners need to succeed. Performance monitoring tracks results against expectations. Conflict resolution addresses inevitable disputes constructively. Investment in partnership success, not just contract negotiation, determines whether relationships deliver anticipated value. Competitive moats create sustainable advantages that protect businesses from competitive erosion. Unlike temporary advantages from better execution or fortunate timing, moats make businesses structurally difficult to challenge. Not all businesses possess meaningful moats, and many that claim defensibility actually face fierce competition. Network effects create value that increases with user base size. Direct network effects make services more valuable as more people use them, as with social platforms or communication tools. Two-sided network effects connect different user types like buyers and sellers in marketplaces. Data network effects improve offerings through accumulated usage data. Network effects create winner-take-most dynamics where leading platforms become increasingly difficult to challenge as they attract more users, who in turn attract more users. Switching costs lock customers into existing relationships. Integration complexity makes transitioning to alternatives technically difficult. Data migration costs time and risks loss. Learning curves require retraining. Workflow disruption impacts productivity during transitions. Financial penalties in contracts explicitly discourage switching. High switching costs reduce churn, but can also limit growth if prospects perceive them as traps. Brand equity as moat provides customer preference, independent of objective product characteristics. Luxury brands command premiums through aspirational positioning. Trusted brands reduce perceived risk in purchase decisions. Familiar brands enjoy default consideration. Competitors must dislodge. Building brand moats requires sustained investment and consistent customer experience, making them difficult for competitors to replicate quickly. Proprietary technology protects through patents, trade secrets, or complexity competitors can't easily reproduce. Patents grant temporary legal monopolies, but require public disclosure and expire. Trade secrets maintain confidentiality, but risk loss through reverse engineering or employee departure. Technical complexity creates practical barriers, where alternatives require substantial development investment. Technology moats erode as patents expire, secrets leak, or alternative approaches emerge. Cost advantages from scale, access to resources, or process efficiency enable pricing competitors can't match profitably. Scale economies spread fixed costs over larger volume. Exclusive resource access secures inputs competitors can't obtain. Process innovations reduce production costs. However, cost advantages require defending the sources of lower costs, since competitors constantly seek ways to match or exceed efficiency. Regulatory barriers limit competition through licenses, permits, or compliance requirements. Highly regulated industries like telecommunications, banking, and healthcare restrict new entrants. However, regulatory protection can become liability if regulations change, or new technologies enable alternatives that bypass traditional regulatory frameworks. Moat durability matters more than current strength. Strong moats that erode quickly provide limited protection. Durable but weak moats may strengthen over time. Technology disruptions, regulatory changes, business model innovations, and customer preference shifts all threaten moats. Businesses must continuously reinforce and adapt defenses rather than assuming current advantages will persist indefinitely. Market intelligence networks provide information advantage through relationships and positioning. Advisory boards consisting of customers, industry experts, or former executives provide strategic guidance and market insight. Customer advisory groups give direct feedback on products and priorities while making participants feel invested in success. Industry associations offer networking, benchmarking, and collective advocacy. Academic partnerships access research capabilities and emerging talent. Venture investments or corporate development activities provide windows into emerging trends and potential acquisitions. Thought leadership platforms establish authority and attract opportunity. Speaking engagements at industry conferences raise visibility. Published research or white papers demonstrate expertise. Media commentary on industry developments positions executives as go-to sources. Podcast or video series build audiences. Open source contributions or technical blogging establish technical credibility. These activities require ongoing investment, but attract customers, partners, talent, and acquisition interest. External communications manage information flow to various stakeholder groups. Corporate communications address general audiences through press releases, company blogs, and social media. Investor relations for companies with outside investors manages financial reporting, earnings calls, investor meetings, and shareholder communications, balancing transparency requirements against competitive sensitivity. Customer communications provide product updates, company news, and educational content. Partner communications keep channel and strategic partners informed and aligned. Employee communications, though primarily internal, shape external reputation, as employees share perspectives through social media and conversations. Crisis communications deserve particular attention, given disproportionate reputation impact. Speed matters because silence enables speculation and competitor narratives. Transparency builds trust, even when news is negative, while obfuscation typically backfires. Consistency across all spokespeople and channels prevents contradictory messages. Empathy acknowledges impact on affected parties. Action orientation focuses on solutions rather than dwelling on problems. Follow-through demonstrates commitment beyond immediate crisis response. Understanding business ecosystems is, in the end, about recognizing how businesses exist, not as isolated entities, but as nodes in networks of relationships with customers, partners, suppliers, competitors, regulators, and communities. The strategic system sets direction, much as the brain coordinates body function. The financial system regulates resources as hormones regulate biological processes. Revenue generation creates commercial viability as reproduction sustains species. Each system, from leadership to logistics, from brand to balance sheet, performs specialized functions that, when coordinated, enable commercial success. Though we study these systems individually, dissecting profit margins here and customer satisfaction there, they operate as an integrated whole. A business, like any complex system, is more than the sum of its parts. It's the coordination, the feedback loops, the adaptive responses that determine whether it thrives or fails. Most businesses that fail do so not from a single catastrophic error, but from accumulated disconnections. Strategy disconnected from operations, marketing disconnected from product capability, growth disconnected from organizational capacity. The beginning of the end, in most cases, starts small. A misaligned incentive here, a neglected customer signal there, and compounds over time until the system can no longer maintain commercial equilibrium. No framework, of course, guarantees success. Markets change, competitors adapt, and circumstances beyond control intervene. But understanding how these systems function, how they interconnect, and how they respond to stress provides something valuable. The ability to make more informed decisions, recognize warning signs earlier, and respond more effectively when inevitably something goes wrong.